Hi, my name is Siddiq Adesha, Chief Investment Officer for Sun Life Global Investments. As we begin to settle into a new normal, the markets are still showing a lot of uncertainty. In March, we saw the CBOE volatility index levels go above 80, about 4 times the long-term average. Heading into June, the VIX has settled into the 20s and 30s, still significantly above normal, but for now, down from the extreme. As we move into the next phases of the pandemic, we continue to manage risk while looking for opportunities for longer-term growth. Join us as we present our Quick Take series. At Sun Life Global Investments, we go through a rigorous process to select and monitor sub-advisors from around the world. In our Quick Takes conversations, they provide important insights into their regions or asset classes. We hope that this diverse coverage will help you manage and stay informed through this period.
Hello, thank you for joining us today as we speak with investment product specialist Scott Edgcomb from MFS Investment Management about the Sun Life MFS Low Volatility Global Fund. Scott, how has the asset class been impacted by the events in Q1 2020?
Thank you for the question. The efforts to slow the spread of the coronavirus brought the global economy to a grinding halt, which led to sharp declines in employment and economic activity across the world, which led to an extremely volatile experience for global equities. Spending by both businesses and households has changed dramatically during the lockdowns, and now, as economies are starting to reopen and people are adjusting to a new normal, we still see a wide disconnect between the economy and the financial markets, which have mostly rallied since the March lows. Many businesses are operating below full capacity as they look to comply with various social distancing guidelines, and we expect volatility to remain elevated as the beaten down economy and exuberant market likely meet somewhere in the middle. Last week, for instance, we saw many states in the U.S. begin to digest rising COVID-19 infection rates as a continuation of the first wave that never fully passed, and uncertainty remains elevated. As we look for investment opportunities for our portfolio, we start by identifying stocks that are less volatile than the overall market, and then we incorporate our fundamental and quantitative research insights to add value above and beyond a basic volatility screen. During these volatile periods, the incorporation of the fundamental research inputs has been critical, as those tend to be more forward-looking and can generate more signal during market inflection points. We focus on profitable companies that we believe have more durable competitive advantages, attractive balance sheets, and favorable liquidity positions. Experience investing through multiple cycles tells us that economic downturns do the most damage to companies with weaker business models, over-levered balance sheets, and an inability to adapt and remain focused on the long term. The ability to weather these more challenging periods is critical to our pursuit of the best possible outcomes. And while the level of uncertainty remains elevated as new information trickles out, we believe having a long-term perspective and staying consistent in our approach to managing the portfolio will benefit clients over the long term.
Are there any sectors or regions that are more attractive given the sell-off in Q1?
The team has been talking about this a lot, as sectors have reacted differently based on their exposure, or in some cases lack of exposure, to COVID-19. Shutdowns, plus lower rates and lower energy prices have compounded volatility in certain areas that have traditionally been viewed as defensive or lower volatility. For example, REITs, and especially those with more retail exposure, underperformed as leverage and exposure to brick and mortar retail became the primary concern, while some more volatile information technology names were deemed stay-at-home or remote work beneficiaries and subsequently outperformed. Additionally, as rates were pushed lower, financial services as a sector sold off, despite certain sub-industries that are less rate sensitive and less impacted by the lower rates. Within healthcare, the medical equipment industry sold off on announcements that elective surgeries were being postponed, which created some attractive risk-reward opportunities. And then within pharmaceuticals, which is already a portfolio overweight, we expect increasing pace of and demand for innovation on the vaccine and therapeutic fronts in order to get in front and be better prepared for any future pandemics or second waves. Across multiple sectors, we expect significant dispersion between winners and losers, with a macro backdrop that is likely to cause stocks to trade away from their intrinsic values, and we will look to identify opportunities for our clients.
Have there been any changes to the fund based on these views?
From our perspective, volatility remains elevated, but we're sticking to our process. We continue to look for less volatile names, leaning on the expertise of our fundamental analysts and quantitative models. Our research inputs focus on higher quality businesses with solid balance sheets that can weather periods of extended volatility. We have a longer term focus, and we think having a long-term focus in this environment is critical, with the understanding that there's very little visibility or certainty into 2020 earnings at this point. So much attention is spent on what earnings are going to be over the next couple quarters. We believe if we stick to what we do best and focus on the long term, we'll be able to add value in our portfolios by keeping that out-year focus. Our global research platform has worked together seamlessly through this period. And the top theme of our ongoing discussions is some things are going to come back to the normal, but many areas are likely to see a paradigm shift with a decade's worth of change brought forward over the next few years. So we're evaluating our respective industry coverage through multiple viewpoints to account for the full potential range of outcomes. For the remainder of 2020 and beyond, as different parts of the economy work to come back online, we think there will be numerous opportunities for us to identify profitable companies with attractive future growth prospects that have been mispriced by the market due to the macroeconomic uncertainty.
Thanks for your comments, Scott. Appreciate your time today.
Thanks for your time.